Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, November 4th, 2025. As always, we'll start with the executive summary from today's lead-off morning note. So let's hop right in. Today's key macro question is the Powell Fed comfortable with the stock market crash to tighten financial conditions? Our short answer is probably not, but we can't rule out this developing possibility given their long and growing history of policy errors. In terms of analytical nuance, the 42 macro paradigm C bull market continues to stall amid concerns of lofty valuations being voiced by senior Wall Street executives, which undermined investor optimism. Contributing to the pullback in investor sentiment was the sell the news event surrounding Palantir's earnings, which saw it below past Q3 sales expectations and raise its revenue forecast. Palantir stock, which is down 10% today and still up nearly 150% year to date, closed Monday at a record $207 with an 85 price to sales ratio, the highest in the S&P 500. when investors forcibly sell stocks that beat and raise guidance, it speaks volumes to how crowded the positioning cycle is. While the positioning cycle itself is not a catalyst, the fact that the stock market peaked right before the Powell Fed signaled it was comfortable with tightening financial conditions when it forcibly pushed back against market expectations for a December rate cut last week is notable. Per last week's FOMC statement, the Fed is currently scheduled to end its balance sheet runoff program on December 1st. The fact that today is only November 4th suggests there's a lot of time and space for big problems to manifest, which could have spillover effects upon broader financial markets, especially given the positioning cycle concerns. To the latter point, our positioning model now indicates there is high risk of a crash in risk assets over the medium to long term, as evidenced by the quantity of stable indicators in the model reaching their respective bull market peak thresholds. Perhaps most concerning is the fact that these indicators are currently as lopsidedly bullish as they have ever been on a median basis at historical bull market peaks, with the exception of the July 1998 peak. The Powell Fed clearly does not understand the role the institution must play in this foreturning or to address the K-shaped economy crisis, KEC, and markets may punish them and us for that over the next few weeks. We currently anticipate the price will be manageable within the context of our Paradigm C theme, but we could be wrong about that. Stay tuned. As always, members of our global investor community can trust that our institutional-grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying on fundamental research alone. Transition to our 42 macro dashboard. As always, we'll wrap up with a question from our community. This one's titled Just a Thought. So it's a pretty long one. So let me just click into it so we can read the whole question. It says, just a thought. I'm part of a private investing club that occasionally discusses different research and investing platforms, and I get the sense that many people don't really get 42 macro. It came up again the other day, and the same question resurfaced, basically in 4 different forms, and I couldn't help but think that a simple 1 or 2 page PDF would clear this up once and for all. So the question is, how should you handle buying and selling when KISS or Dr. Mo changes? Says, now I know this is covered in the FAQ, but people tend to ask it in 4 specific contexts. Number 1, when you're still accumulating. Number 2, when you're withdrawing. Number 3, when it's a taxable account. And number 4, when it's tax deferred or tax exempt account. I think a short PDF could walk through this in a structured way. Maybe start with the simple top down and bottom up percentage overlay, and then reference the backtest results, and finally walk through those 4 scenarios with straightforward guidance. I'm not saying it would drive a ton of new subscribers, but it would really help people better understand how to apply the platform's framework in practice. Maybe it's a small idea, but it could make a difference. So I'll start by saying that if you are evaluating a risk management overlay through the lens of your very specific, unique tax situation in terms of the accounts that you have your assets, in terms of the rules of the accounts that you have your assets in, or in terms of your own specific tax, tax situation, I think you're doing yourself and your family a disservice. Full stop. The whole purpose of using institutional grade risk management overlays to guide your asset allocation and portfolio construction is to stay on the right side of market risk. If you prioritize whatever your tax considerations are over staying on the right side of market risk, that's a choice you're making. But be aware that you can't serve 2 masters here. You have to choose between staying on the right side of market risk or prioritizing your unique tax situation that is unique to you, the single person that you are in the context of the millions, if not billions, of investors around the world. We cannot design a risk management overlay that satisfies everyone's very unique, highly specific tax situation. So what we did instead is optimize it for staying on the right side of market risk. And so some of you may be able to implement all the signals with no penalty in your tax accounts or whatever, or some of you may have penalties. I don't care. That's not the point. The point is to stay on the right side of market risk. Again, you can optimize for one or the other, but you cannot optimize for both. So you, the investor, has to make a choice. What are you optimizing for? Explosive gains in bull markets and chopping off the left tail of the distribution when you're in a bear market? Or are you maximizing to have terrible returns, but really good tax consequences? Again, you cannot serve two masters. You can either have great returns and great risk management in bear markets, or you can have average to below average returns with fantastic results from a tax perspective. Which one do you want? You have to make that choice. You cannot serve two masters. And so, wrapping up, I'll just read what one of our other customers said. It says, I've been following and now implementing 42 Macro's ideas for at least 3 years with great success. Darius's work is exceptional. I use a slightly modified KISS in part for my clients' portfolios across all 4 scenarios. Every person's situation is different, so your investment group members will have to analyze their situation accordingly. Let me read that paragraph again. It says, I've been following and now implementing 42 Macro's ideas for at least 3 years with great success. Darius's work is exceptional. I use a slightly modified KISS in part for my clients' portfolios across 4 scenarios, all 4 scenarios. Every person's situation is different, so your investment group members will have to analyze their situation accordingly. Again, this is from an investment advisor who's using KISS and slightly modified versions of KISS, either the standard KISS or the slightly modified version of KISS, to create extremely positive outcomes for his clients. Continuing on, it helps to look at KISS for what it is, an outperformance engine with significant downside mitigation. Let me read that again. It helps to look at KISS look at KISS for what it is, which is an outperformance engine with significant downside mitigation. As you stated, buying and selling is covered in the FAQ. In short, sell quickly and buy slowly. Again, we cover all the stuff in the FAQ, so definitely check out the KISS FAQ if you have any questions on how to implement KISS. The actual, it's obviously incredibly simple and straightforward. That's the whole point of the program. But if you have any questions on the simple and straightforwardness of KISS, definitely review the KISS FAQ. So getting back into reading the reply here. This is how I modify KISS for my personal accounts, not advised in the following sell quickly but slowly strategy. So number one, so I'm going to go back and forth between the 4 scenarios. Number one, when you're still accumulating, he advised that this investment advisor advises his clients to follow KISS as is. If that's too much work, I set and forget 42 Macro 60, 30, 10. Number 2, when you're withdrawing, keep 1 year's worth of withdrawals in cash, 5 to 10%, and follow KISS with the rest. I refill the cash bucket during the year when the sell signals materialize. Number 3, when it's a taxable account, follow KISS as is. At the highest effective federal and state tax rate, which is 50.3 federal plus California, KISS would have to grow at slightly over 9% per year to offset a tax refund paying 4.5%. For my calculation, KISS has returned over 12% per year since 2018. I don't let the tax tail wag the dog, 2.5x growth dog. And just real quick, it's actually 17%. I wonder if that's a typo. But the KISS, the rolling out a sample back test that we perform and maintain for KISS has a CAGR of plus 17% since January 1st, 2018. So just be aware of that. And then finally, when it's a tax deferred or tax exempt account, follow KISS signals as is. So in 3.5 or really 4 of these scenarios, you should be following KISS as is. And in the one scenario where there's a real, kind of retirement withdrawal consideration, this person keeps 1 year's worth of withdrawals in cash, and then he uses the rest to follow KISS as is. So in conclusion, as this person writes, so as Darius tells us every week, retail investors should just follow KISS. Again, I have not come across, I've been doing this for almost 2 decades now. I've not come across a system with such a positively skewed return distribution. The Kalmar ratio of KISS is 1.4. Kalmar ratio is your compound annual growth rate divided by your max drawdown of the strategy. The Kalmar ratio of 60-40 is 0.4. And if you wanted to run 60-30-10 stocks, gold, Bitcoin with no risk management overlay, so you're just always long and you're suffering the drawdowns associated with that strategy, the Kalmar ratio is 0.8. So KISS, if you're implementing KISS, you have basically a 300% upside capture ratio relative to 60-40 with only a 60% downside capture ratio. If you're implementing KISS relative to 60-30-10 stocks, gold, Bitcoin, you have a roughly 90% upside capture ratio with a 50% downside capture ratio. It's about as positively skewed return distribution as anything you're ever going to touch, see, taste, or feel as a retail investor. And so this goes back to my original point. Don't fix what isn't broken. Stop worrying about taxes. Stop serving the tax master. If you're basically, if you're in California, you need to, the only thing you need, the return stream you need to offset a taxable account in California is 4.5%. KISS is returns, according to that rolling out a sample back test, almost 4 times that. So should you be concerned about paying taxes? Absolutely not. You're trouncing any sort of tax benefit you get from adhering to a worse strategy that does not manage risk. And oh, by the way, the underlying question in all of this is, should I manage risk or should I pay taxes? Or should I not pay taxes? And I'm telling you right now, if you're at or near retirement and you choose to serve the tax master instead of the risk management master, you have a great chance of losing 20 to 30, upwards of 50% of all the money you spent your life accumulating because you're so hyper-focused on taxes that you fail to manage risk. And so to me, I think you have to make a choice. No strategy is perfect. No strategy is going to give you such a positive skewed return distribution without managing risk. And so obviously you have to choose between managing risk or serving the tax master. If you serve the tax master, just know that you might blow up your account trying to avoid taxes because you're not managing risk like KISS does. So we'll wrap it up there. Darius here presenting our macro minute for Tuesday, November 4th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.